Afternoon to all of you, and let me welcome you to the seventh session of the South Carolina Home Attainability Forum. As we all know, if you don't know, this session started back in August of 2020, and this is the seventh session of many that took place. Now, today's session will provide an overview of the financing challenges facing prospective home buyers, builders, developers, and creating barriers to affordable home ownership. Let me thank the Home Builders Association for facilitating these sessions over the course of the years, and we hope and we pray that it has been very, very valuable to those of us who are interested in home ownership here in South Carolina. Before we get started, I'd like to thank our sponsors who making this available for us: Crescent Homes, Connolly Brothers Incorporated, Great Southern Home, Quinn Homes, and Mungo Construction Company. We'd like to thank those individuals for sponsoring us and supporting the Home Builders Association of South Carolina. Let me introduce our speakers for this afternoon. We have several of them, and hopefully you will be able to see them and be helpful to you in helping us make sure that everyone has the opportunity to afford what we call one of the American dreams, and that is home ownership. Our speakers for this afternoon is Mr. Robert Dozier. He's president of First Reliance Bank Share and COO of First Reliance Bank, my home bank. Phil DeMarshall, excuse me if I pronounced that wrong, sir. Phil DeMarshall, he's with TD Bank, and John Vareau with TD Bank as well. We all coming with us later on. He hasn't gotten on yet, but we also have coming on with us later on Senator Ronnie Cramer, my friend and my colleague. I've grown to appreciate Senator Cramer over the years. We serve on several other committees outside of the General Assembly. He's from Lexington, Newberry, and Union counties. He's also chairman of the Banking Committee. Now, Senator Cramer was going to kick this off as our quote unquote keynote speaker, but he is not here with us right now. So as it comes on, we are going to fit him in as we see fit. So our first speaker, if you will, to give us this information is Robert Dozier. Again, Robert Dozier is the president of First Reliance Bank Shares and COO of First Reliance Bank. Mr. Dozier, we're going to let you now have it, and you just give us the information that you want us to have. And let me say this too, for those of you who have mentioned, that this is being recorded. So this is being recorded. Amen. Amen. Okay, Mr. Dozier. Go right ahead.
Representative Alexander, thank you very much for letting me join you today. And I am with First Reliance Bank. I appreciate that. I spent the last 10 years in Atlanta at the Federal Home Loan Bank of Atlanta, working with 900 financial institutions around the Southeast. So some of what I talk about today is some of the things that I've seen that worked, and then I'm going to try to bring it back down to the conversation in South Carolina. But for you and Senator Cramer to be hosting these kind of programs with home builders and Habitat, Nancy Lee's behind the scenes doing a lot of this driving today, the conversations that are beginning to take place will prove to be just incredibly valuable. So we'll go to the first slide, Nancy, for me, the next one, and just talk about what's the definition? We had some questions that were sent in earlier. What's the definition of affordable housing? It's affordable dwelling is one that a household can obtain for 30% or less of its income. So there's some challenges with that definition today. That's been the same practice for the last 20 plus years, mainly based out of Washington, D.C. and HUD, Housing and Urban Development. Most programs that we use to bring dollars to the table to help with affordable homeownership are based off 80% of area median income. Representative Alexander, your area median income, you know well, in Florence, South Carolina is $46,000. 80% of that is right at $37,000. Your first year teacher at one of the Florence school districts is about 38,000. So they miss the program eligibility because we're using 80% of area median income. So one of the first takeaways that I hope is that we can take away is I think we need to have the dialogue from the state level move up to DC to change that definition. We should be talking in today's world using 100% area median income for qualification of these programs. And because AMA swings wildly from city to city, I put wildly in quotation marks, there's just obviously not a consistency. So the program parameters in Allendale is going to be different than Florence and different in Richland and different in Newberry counties. So that's a challenge. Next slide, Nancy. What we need to do as a group is really address, instead of affordable housing, it should be accessible housing and attainable homeownership. We need to work to use all our resources to create a pool of affordable housing. I put development in quotation marks. I just think there are programs and services. I'm going to try to walk us through in my short time with you how we can layer on those and really not have to reinvent the wheel, but what's available that we're not using today and what can we use more of to make sure that we create this portal, if you will, of affordable housing opportunities. I use the example a lot. Just drive around. Anybody on the call today, drive around to your local hospital. We've all been in the COVID crisis focused in on our healthcare workers and frontline people in the middle of COVID. There are a lot of folks at the hospital that are in the affordable housing eligibility category. How much vacant land is around your neighborhood hospital? Are we working with the hospital, the county, the state, and any federal programs to create affordable housing so that whether you're a janitor at the hospital, whether you're a nurse at the hospital, or anybody else that can qualify for it, has a homeownership opportunity around where they work to create that workforce? And we'll talk about the economic benefits of that in a minute. But also we need to work at making sure the biggest barrier to homeownership is down payment. And so are we creating and utilizing down payment opportunities? And with that, looking at especially the appreciation of real estate in the last 12 months in South Carolina, which is great. I love the fact that a lot of people are coming and moving from up north and they finally figured out that South Carolina is a wonderful place. That's why I'm back. This is home to me, but it's creating some challenges. That's another takeaway that we really need to work on, keeping prices under control. Next slide, please. So I look at accessible and attainable homeownership in two buckets that both grow up and would be in the benefits category. Sometimes we forget the basic value of homeownership. For those of you who own your home right now, I challenge you, when you go home today, when you get out your key to unlock your door, just think about how fortunate you are to actually own a home and what that does. And sometimes we take for granted that putting a roof over somebody's head actually helps build confidence and self-esteem. Actually, in many, many cases, we can point to homeownership as being the foundation of creating a family. And if you do that once, those are incredible benefits. You do that twice, you've created neighborhoods. You do that several more times, you've created neighborhoods. You do that several more times, you start building the community. And that's what we've got to talk about. It's not just that one person getting into the home. It's what it does. And I'm going to try to prove that out a little bit later by using some data, but building the economy through job creation, the tax base improvement, improved infrastructure, all are benefits of supporting and getting behind affordable and attainable housing. Next slide, please. So the impacts of affordable housing, investment in affordable housing creates an economic multiplier effect. In fact, I'm going to show you through some dialogue with the Federal Home Loan Bank and studies that for every dollar in affordable housing that we put in, we get $1.8 into the community. Pretty powerful statistic. builds the local tax base, boosts job creation and labor income. Next slide. So our bank's committed. I'm with First Reliance, and I'm on with some partners at some other banks today, and we're all part of South Carolina Bankers Association and working together. We believe we can do well by doing good. It's part of Representative Alexander. I'm glad you mentioned. I didn't know if I was supposed to call you out for being a customer of First Reliance Bank, but we are your bank, and we believe in building the communities that we're so fortunate to serve. So we're building those communities. We support, and we're leaders in an affordable housing story, which is paramount. We're using our balance sheet as a local community bank to help build those 8 communities that we serve throughout the Carolinas. We do that with our own balance sheet and external partnerships, including our membership in the Federal Home Loan Bank of Atlanta. Now, a lot of people, got a lot of great folks on who might not have ever heard of the Federal Home Loan Bank of Atlanta. It's the largest bank that nobody's ever heard of. It's the bank for the banks, if you will. They serve as the bank for the 900 financial institutions around the Southeast, roughly 90 billion in assets. And with that, part of their government-sponsored enterprise charter is to take 10% of their net earnings and put them back into affordable housing throughout the Southeast. So 2 years ago when I left, we made $400 million that year. So $40 million was available for affordable housing projects. I will tell you, South Carolina got a slim piece of that because states like Virginia, states like Maryland, states like Alabama have been at the forefront of utilizing those dollars in their first come, first serve. So I would submit that as we do follow up, we need to talk about how do we get a bigger piece of a pie that's already available before we start tackling ways to develop new programs. Next slide. So our piece with Federal Home Loan Bank, we divide in a couple of buckets. We have finance construction for affordable renter and owner occupied housing or development. And then we have down payment assistance for mortgages for home ownership purposes. Next slide. So this is just a graph of those 3 buckets that I talked about. The first one is called the Affordable Housing Program General Fund, where developers and sponsors for new construction, rehab, multifamily can get up to $500,000 in grants from the Federal Home Loan Bank. You would come through a member bank like First Reliance Bank in Florence, South Carolina, and apply for and potentially receive a grant of $500,000. Why is that important? We like to think of those grants, that $500,000, as the magnet that then will attract other dollars, whether federal programs or state programs, that you can start layering on and reduce or mitigate the risk as you're developing affordable housing projects around the state. The second column there is affordable housing home ownership. We do that in the form of partnership with the Federal Home Loan Bank of Atlanta through down payment assistance programs. For instance, back to that hospital example, we can take a healthcare worker and through our membership with Atlanta, give up to $10,000 in affordable housing grants. I will tell you again, out of the 44 headquartered banks in South Carolina, we are not getting our share of first-time homebuyer down payment assistance and community partners. That's healthcare workers, that's first responders, and that's educators to be able to use up to $10,000 for down payment assistance. The third column I just put on there because we like to talk about financial institutions that are involved in affordable housing can get discounted advances. Don't be scared by the word advance. That's just a loan from the Federal Home Loan Bank to a financial institution. So if Representative Alexander had a development and came to First Reliance Bank and we targeted that development as affordable housing and it met the criteria, we could do subsidized or reduced interest rate loans for that project that would be passed on to the borrowers. Next page, please. So just the economic impact, and I'm going to go on that development piece first and just hit some quick numbers. Federal Home Loan Bank had the University of Florida State Economic Forecasting and Analysis Division do an economic impact study And over a 16-year period in South Carolina, there were $59.57 million of affordable housing subsidies. And remember, I said earlier, South Carolina, I don't think is getting its fair share because we're not all working together to go collect those dollars. But that $59 million in AHP subsidy equaled $626 million in development. 546 projects, 8,792 units. And if you'll go to the next page, the economic impact of that was $1.55 billion, 11,000 jobs created, and $539 million in labor income. That's putting the math and the economic benefit behind affordable housing. And there you see, I mentioned earlier, alluded to it, the 1.8 multiplier effect. For every dollar in affordable housing, those numbers that I'm showing you equals 1.8 in economic impact. And you can find that study at the Federal Home Loan Bank of Atlanta website in its entirety. Next page. Going directly to home ownership, the down payment subsidies, Federal Home Loan Bank to Atlanta has given to South Carolina institutions $10 million in down payment subsidies. Those have supplied $173 million of first mortgages, or 1,700 units. Next page. For a total economic impact of almost 400 million, or a 1.83 multiplier effect. Again, trying to do the good nature of affordable housing into just an economic driver that we need to talk about. And then the last page, next page. This is just an example. There's a question on from the audience about does affordable housing in the middle of a community impact the value of other properties? Representative Alexander, you might be familiar with this. This is in downtown Darlington. I picked this one obviously because you were going to be on here today. So this was a $5.6 million historical building that used an advance of $340,000 from the Federal Home Loan Bank, which then was a magnet to bring in 2.9 million of low-income housing tax credits, historical tax credits, because it's almost a 100-year-old building, community development block grant of 500, and home funds from HUD of 500. So all that to rehab this in downtown Darlington to create 28 1-, 2-, and 3-bedroom apartments for low-income families. I don't know what is better than to provide affordable housing opportunity and do economic development and revitalization all at the same time. So for my final point, I would submit that one of the takeaways is let's sit around a table. Let's list out all the programs that are available that we're not taking advantage of, put them together, and let's all commit to building South Carolina in a better way. Thank you for your time. Thanks for letting me be on.
Thank you, Mr. Dozier, with that information. And I can assure you in the next week or two, I'm going to be sitting down with you and having some additional conversation on how we can move these programs forward, particularly here in the PD area. I mean, in general across the state, but particularly here in the PD area. And I appreciate that information. So very much questions, but I'll wait to the question and answer period to do so. Next, we will have, again, thank our sponsors for putting this on for us. Next, we will have Mr. John Vareau of TD Bank. Mr. Vareau, you have the floor.
Thank you, Representative Alexander. And Nancy, are you going to be able to share the screen? As soon as we get the screen up. Nancy, you there? Okay, thank you. Okay. Thank you, Nancy. As Representative Alexander said, my name is John Vareau. I serve as the Community Development Officer for TD Bank across our footprint in North and South Carolina. I live and work in Spartanburg, but my office, I like to joke, is in my car. And I appreciate being a part of this panel today. When you hear about the word housing, the term housing, that can conjure up a lot of things, whether we're talking about affordable housing, you've heard the term workforce housing, multifamily, mixed income, rental, and then of course, home ownership. And regardless of which type of housing we're talking about, it's an issue not just in South Carolina, but all across the country. And one thing that I've learned in my short time in this role in community development is that there is no one size fits all solution. Each solution in each community is unique, but we can really learn from our neighbors in the other communities. And so today, my objective is to address and to add on a little bit to what Robert just said about the definition of affordable housing. Also look at a couple of numbers relating to the need of housing in South Carolina, and then consider our perspective or perception of what we think of when we think of affordable housing. I would like to say and acknowledge to the Home Builders Association, calling this seminar Housing Attainability, I think is a good thing to do. A lot of times what we call something can carry a positive or negative connotation. And I think we need to get away from the term of low income housing, the moniker, and work toward a name that carries less negativity and more dignity. Go on and go to the next slide, please, Nancy. I also think it's important to have a basic understanding of how we got to where we are. You're all familiar with the concept and the practice of redlining. Back in the early 30s, there was the Homeowners Loan Corporation. It was a federal agency, and they, along with other government housing programs, contributed to desegregated neighborhoods and the public housing projects that we still see around today. A good explanation of this history is contained in Richard Rothstein's book, The Color of Law. If you've not read the book, I recommend it, but if you don't want to read it, at least go online and watch one of the videos of him speaking. He was in Columbia a couple years ago, and you can do that in roughly 60 minutes. The Fair Housing Act was passed in '68, prohibiting discrimination for any type of housing. And then in 1977, Congress put more teeth into the fair housing legislation through its passage of the Community Reinvestment Act. Robert touched on this a little bit in his talk. A lot of times you just hear the Community Reinvestment Act referred to as CRA. CRA was a law of economics. The law states that banks, and this is true of all banks, were required to make investments or provide loans and services to all members of the communities that we serve. For example, if a bank has an office in a neighborhood, a town, or a community, then that bank is required to make a certain amount of loans and or investments in the census tracts served by that location. Those census tracts are referred to as an assessment area, and depending on the bank's performance in that assessment area over a 3-year cycle, it will receive a grade of outstanding, satisfactory, needs improvement, or fail from the OCC. So we are regulated by what we do. Flip on to the next page, please. Again, Robert touched on this, but I'm going to take it one step further. I don't like reading PowerPoint slides. I know you probably don't like having them read to you, but before I go into this particular slide, there's a basic economic concept that we all need to understand. And investing and building affordable housing requires approximately the same amount of capital as it would take to invest and build market rate housing. In other words, the cost for building affordable housing is not that much different than building market rate housing. Therefore, because the return is much higher for market rate housing, all of the capital is going to naturally flow into market rate projects. Therefore, in order to incentivize the new construction of attainable housing or affordable housing, whatever we want to call it, or the rehabilitation of existing stock, financial support in the form of federal or state or local programs is required in order to motivate the capital flow into that affordable space. It's just a basic economics. I think we all need to understand that the ROI, the return on investment, or return on capital is improved by using public subsistence. That financial support varies, but examples can include tax credits that Robert just showed us. There's special programs out there for first-time home buyers. There's down payment assistance. South Carolina Housing has special programs for development of rental property. And then local governments have programs aimed at addressing special needs in their communities. Almost all of these programs revolve around area median income, or AMI. And one's ability to qualify for housing is usually based on their income. So if you look at those definitions on this chart, you'll see, as Robert said, affordable housing is generally defined as housing which an occupant's paying no more than 30% of their gross income. But then we have the term LMI, stands for low to moderate income. And this is where the occupant living in that unit, their income is less than 50% of the area median income. Or if the occupant's income is above 50%, but less than 80%, then that's considered moderate. You've heard the term workforce housing. Everybody wants to know, what is workforce housing? Well, workforce housing is most commonly intended for households whose income is between 80% and 120% of the area median income. To my knowledge, there are no federal programs available that support workforce housing. And if you think about who those people are, 90% of those people are the school teachers and the first responders, the nurses, people coming out of college. They're not making a whole lot of money. Some of them maybe haven't been to college, but the point is, there's not enough housing for these people. Quite frankly, what happens is a lot of people in this workforce income category may be moving into the affordable space because they can't afford anything above workforce. And so you've got this big mix match problem going on. There's a term called cost burdened, and that's where individuals are paying more than 30% of their income for housing. That's a big problem in South Carolina. I'll show you that in a second. And then South Carolina Housing, SC Housing, is in its last couple of annual reports talks about shelter poverty, where the condition of, that's the condition where one's housing costs make it impossible for them to cover the other essential household expenses. In other words, one's income is almost all of their income is going towards rent and utilities. They don't have enough money for the other necessities in life, food, maybe medical expenses, getting back and forth from somewhere, and therefore they have to rely on other public charities, or maybe you have a lot of people moving in together, but that's the shelter poverty issue. I've listed some median incomes for you. You can see the difference just between Greenville, Richland, Charleston, and Horry counties. That's a family of 4 median income. You can do the math, 50%, 80%, and 120%. There is every community in this state has a waiting list of people wanting to get into low income or affordable housing. And so we've got a dilemma or a conundrum in front of us, is how do we reconcile construction costs that are rising at a rate much greater than wage increases do? So we've got construction costs going up, but these median incomes are not going up nearly as much as construction costs. And that's creating a gap. Let's go on to the next page if we can. So here's a chart. Again, I borrowed this. I'm giving them credit from South Carolina Housing's annual report in 2021. You can see how our population's increased by 28% over the last 10 years, which is good. Median household income is up 51%. Had a lot of people moving into the state, a lot of new jobs popping up, good paying jobs, so that's driving up median income. But look how much median rent's gone up, 81% almost. So you can see the pressure that that's putting on people. Here's another statistic, 31% of South Carolina households are in shelter poverty. We just talked about what that means. We've got over 140,000 renters that spend more than half their gross income on rent. Those people are extremely cost burdened. So it gives you an idea of the need. Flip on to the next page, Nancy, please. These challenges create opportunities. I just borrowed some comments from local news outlets, but you can see where the Charleston Metro Chamber projects they're going to need 2,600 affordable housing units in the next 10 years. Each year, 2,600 units per year over the next 10 years. Greenville Housing says they're going to need 10,000 more units by 2030. Article down there from the Sun or from WPDE about hospitality workers in Myrtle Beach. Can't find anywhere to live downtown where all the, where they work. I know when I used to live in Myrtle Beach would bus people in from other places like Georgetown and Florence to work there. Article up in the top right-hand corner about Greenville being one of the top cities in the nation now and coming out of the pandemic. So there's a lot of challenges, but challenges create opportunities. And I think one of those challenges, flip on to the next page, Nancy, is changing what we think affordable housing looks like. I wanted to, I'm going to show you some pictures of some projects that the bank has been involved in. And this one's in the Augusta Road area of Greenville, South Carolina. And anybody will tell you that that's probably one of the higher income neighborhoods within Greenville. This is a multifamily apartment complex. At first, when this was announced, there was some pushback from the neighbors, but we cannot discriminate. And as you can see from the landscaping and the design, this was very nicely done. And that's another challenge to get over this NIMBYism, not in my backyard. And this is an example of where we overcame that. Go on to the next one, please, Nancy. This is one of my favorite projects. This utilized low-income housing tax credits as well as new market tax credits. It's an urban setting, downtown urban setting. And we have a multifamily, multi-use, 62-unit project. 32 of the units are for individuals in that 80% or below category, so that's low to moderate income. But 30 of the units were designated for workforce housing. So those are the people between 80 and 120%. And then on the bottom floor, there's some retail space. But again, this was done in an urban setting. There's two pictures down there at the bottom or from inside the apartments. Flip on to the next slide. This is, I'm sure a lot of you are familiar with Spartanburg's Northside developments, come a long way in the last few years. If you look at that picture, the building there on the right, new market tax credits, it's multi-use. You've got renters in it. You've got some office space down in the bottom. And then on the left side is low-income housing tax credits, apartments that are in the process of being leased up now. Going back to the question that somebody asked, revitalization of a neighborhood, there's probably been close to $100 million of investment on that street right there within the last 2 years. And then also in the same neighborhood, there's a mix of housing going on. There are single-family residences that are currently under construction. They're about 1,600 square feet. although the footprint for each house is about 800 square feet, so it's a 2-floor unit. Flip over to the next slide, Nancy. Duplexes are under construction in the neighborhood, and there's an aerial view to the right. And Nancy, flip on to the next. Not everything has to be done in an urban setting. This is another multifamily apartment unit, about 60 apartments in the Vareau section of Greenville. Vareau is a nice area that's up and coming out near Interstate 85, so it's not downtown Greenville. These units are being made or are made to clientele meeting that 80% test. Flip on to the next one. Another picture from the same complex. As you can see, amenities come with them. And this particular unit is going to be doubling in size later this year, so they're adding on. Again, there's a demand. And speaking of amenities, next slide, Nancy. This is in Blythewood, South Carolina. Again, it's not urban. It's out and about a little bit. 56 unit apartments, but you can see a couple of the accessories that go with it, with the workout room and a computer room there for the use of the people that live there. So, and I go back and I'm gonna say this one more time, but from a banking perspective, these are highly desirable credits. They very rarely hear of a default. You very rarely hear of a default with this type of project. This particular unit here, I think, leased up within about 45 days if it took that long. So it's amazing how fast it can happen. And so in closing, Nancy, if you will flip over to the last slide, and I think this is going to be pretty interesting, especially if we have a lot of home builders on the phone or on the, this is a proposal that is currently in front of the, I guess, our legislature. It's been endorsed by state housing, but there is some American Family Rescue money that's being made available to the state of South Carolina. And a portion of that money is being asked to be used for an affordable housing equity equivalent fund. The details have not been worked out, but this is just an overview of what's being talked about. And you can see that it's about a $40 million request. 20% of this would go into a pot, so to speak, to help with affordable rental housing. The investment would be an interest-free. So if you use this money to build rental housing, the loan that you borrow would be interest-free, be deferred for 10 years in urban areas, 15 years in rural areas. And then at the end of the 10 or 15 years, as a developer, you would pay this money back to the fund. Therefore, that allows this fund to be sustainable, can be used for future projects. The funding would be invested in a non-competitive process on a first-come, first-served basis. And then there's also would be a set-aside 25% of the funds, so that's roughly 10 million, would be set aside for home ownership development. So for builders of single-family homes, they could borrow up to 90% of the cost of the home. Again, interest-free. I would think if I was a builder, I would find interest-free loan attractive. And then, of course, when that house sells to the end user, you pay that fund back so that money can be used again. But this is in front of our legislature. I would encourage you to, talk to your local legislature. And, I think this is something that we can get excited about. It's something that's needed in South Carolina. I know about this because of some involvement I have with South Carolina Association for Community Economic Development. So I want to give them kudos for coming up with this idea and working with state housing. And I'll just leave it here. Wanted to give you the people out there. So many times we stand up here and talk about facts and figures, but we don't really offer any ideas or solutions. And I think this is a a good possible solution that may come to fruition sooner rather than later. So I'll just leave it at that. Thank you.
Much, Mr. Vareau, with that information. I'm sure that individuals who are on this Zoom have many questions for the two of you. I have several on my own. I've just been noted that my friend and my colleague on the other side of the chamber is with us, Senator Cramer. Senator Cramer is from Lexington, Union, and Newberry counties, and he's chairman of the Banking and Insurance Committee. And Mr. Phil, if you don't mind, could we allow the senator to come in and give us his comments, and then afterwards you can proceed with yours. We have more than enough time, if you don't mind, please, sir.
Yep, absolutely.
Again, let me Crescent Homes, Connolly Builders Incorporated, Great Southern Homes, Hunter Quinn Homes, and Mungo Construction. Mr. Senator, are you with us? Nancy, do we have the senator with us?
It looks like he just got disconnected. So if you want to go ahead and let Mr. Phil speak, we can circle back to the senator when he logs back in.
Okay. All right, Mr. Phil with TD Bank. Mr. Phil Dumasol, did I get that right?
It's Dumichel.
Thank you very much for being with us. He's also with TD Bank. You have it, sir.
Thank you, sir. Everybody, I'm just making sure, Nancy, they can see my screen.
Yes, sir, we can see it.
Yes,
right.
Yeah.
Technologically challenged at times. I'm on the other end of the spectrum when it comes to involvement in housing attainability, affordability. I'm in the front lines as a mortgage loan officer, and come at it with a somewhat unique background. I spent 20 years in the nonprofit housing industry doing home buyer education and housing rehabilitation programs and development, et cetera. So a little bit different perspective there. And now as a loan officer, TD has me focused at, I'm highly incented to work with first-time buyers, people with lower incomes, et cetera. But I handle all different types of mortgages. And I thought I was going to be able to, there we go. Okay, so I'll just let everybody know that Nancy's going to be able to have a copy of my presentation. So instead of trying to scribble things down quickly or take screenshots, you'll be able to access this next week. So just from the mortgage officer, I just thought I'd touch, real quickly on, what it takes to get somebody approved. And, obviously they need, I refer to it a lot of times when I'm talking to a potential buyer and doing a home buyer training class, et cetera, is, it's a three-legged stool: qualifying income, verified assets, and the credit profile for that the lender is looking at. So, and then just quickly, since I know we're running out of time, and I want to leave Senator Cramer some time as well, but the emphasis is on qualifying income, and we're in a world where people's incomes and the way they get paid is changing, evolving, so that there's a lot more people who are 1099 or self-employed, which is in the long run may be a great thing, but it presents challenges for lenders. When you're dealing with a straight W-2 employee, they've got a base income, a salary or an hourly rate. It's pretty easy to calculate what their income is. It gets a little bit more complicated looking at overtime, bonus, and commission income, where a lot of the time we need to average their earnings for a 2-year period. But when you get to self-employed, sort of an exception to have anything less than 2 years on the tax return to be able to calculate what their income is. And I've actually got a son-in-law who just recently transitioned over to being, 1099, great opportunity, et cetera. But it's like, he and my daughter won't be able to buy a home for at least a year, and probably more like 2 years, because they won't be able to qualify for financing regardless of what their down payment and what he's bringing in, because it's all based on what's on the tax return. And then, assets, and it's verified assets for, the different expenses of buying a home: down payment, closing costs, prepaids, and escrow expenses. and sometimes reserves, money left over after buying the house, are sometimes, absolutely critical for getting a loan approved. And it's sometimes very surprising what's needed, based on if you just look at, the credit score and what the debt ratios are, et cetera, of the customer. And then I just on credit, it's not just the score. I mean, too many potential buyers think, oh, I got my score up to, where I wanted it to be and I'm all set. Well, your credit, it's the whole profile, and the credit report has lots of information that can make a difference in both the approval and qualification of a borrower. So it's, the debts and obligations that are used to arrive at the debt to income ratio, the length of time that they've had different accounts, their payment history, the types of different accounts that are out there, any kind of public records, collections and charge off, balances on credit cards, et cetera. So I'm going to keep moving just to try to pick up a little extra time here. And if one of those legs of that stool is missing, of course, the stool's not going to stand, and you can't. It's difficult to get them approved for a mortgage. So the loan approval process, I don't think there's a lot of general public understanding that the majority of conventional loans, the types of loans that we're talking about, anything under about $550,000, they're generally approved by a computer program that's provided to the lenders by Fannie Mae or Freddie Mac. There's a couple other ones out there that like USDA Rural Development uses, has their own software, but those loans are used by almost all lenders to approve the loans, and it reads the details of the application, the credit report, what their income and debts are, how much reserves they have. It's a very complex and sophisticated program, and the lender in those cases is essentially responsible for making sure the documentation in the file supports the details, for the loan approval. And that software, gives the lender a lot more flexibility than they might otherwise have, looking at, what's in the traditional lending guidelines. And then there's something called lender overlays, which are, bottom line, they're additional requirements that that lenders put on particular loans that, that they're going to require. That might be, an example might be requiring. Especially during the pandemic, a lot of lenders went to a 640 or a 660 minimum credit score for FHA, whereas FHA allows a much, the regulations allow lower scores than that. And the bottom line for those loans is once they're approved, the lender is sort of a little bit on the limb here, because if something called broken loans, it's when the documentation or the loan details in the file, because a lot of files get audited, and if they don't meet requirements for approval, it's considered a broken loan, and the lender basically has to hold that loan on their books at a discounted value, which to the common person that means they've got a loss on that loan. So one $200,000 loan might equate to a $25,000 or $30,000 loss on their books, even if it's never late and paid on time. So there's some risk involved there, and that's why the documentation requirements are so specific, but to each in terms of what lenders need. So what are the tools that we have in the toolbox? So I think it's understood, but people don't always think about it. But the decision to buy is based, after they decide, I like the house, I like the location, what's it going to cost me? What's my payment going to be? And how much money is it going to take out of pocket? Especially for first-time buyers. And that's becoming more and more difficult as house prices get out of sight. It's been somewhat offset over the past few years by low interest rates, but there's no guarantee that that's going to continue. And if you think that's going to happen, it's probably not a good idea to continue thinking that. So lenders have portfolio loans. That basically means they're lending their own money. They're created to meet what they perceive as local needs and to address attainability or affordability. But there's limits to what they can offer. They still have to make what are considered to be safe and sound or prudent loans. And there are variations in how those different programs are set up by different lenders and where they're offered. They might offer them in particular geographic locations or cities or communities and not in others. And of course, depending where the bank is focused, they may or may not that may or may not offer anything particular in every area that they serve. And a lot of times those are set up to offer lower down payment so that fewer assets are needed, makes it easier to get the customer into the home, or reduced fees. Or their loan programs where they're structured where there's no monthly PMI payment, which helps the borrower with their debt to income ratio and the affordability and payment comfort. And it's not just whether we think it's affordable, but whether the buyer can fit that payment into their budget. I know I have a lot of customers who used to come to me with wanting a $900 or $1,000 payment, and at least in the Charleston area, and increasingly in other areas as well that I work in, up in the Florence area, for example, it's getting harder and harder to find a home where they can end up with a payment in that range. So an example of a portfolio loan is TD offers a program where it's a 97% loan, there's no monthly PMI, and we offer, we waive our about $950 on fees on loans that are typically used by lower income buyers, so that reduces the amount of out-of-pocket costs they have to get into the house. And that program is focused on incomes less than 80% of median, but there's no income limit in certain target census tracts. And that's pretty similar to what you might find with other lenders. And again, this is generally through banks, direct lenders. They're lending their own money. You're not going to find that with mortgage companies, and not all banks offer that. And then another place that lenders will sometimes and can help, pretty much any lender can do this, is to help with closing costs by offering a higher rate, but that means a higher payment to the buyer. So they're reducing their money out of pocket, but they're squeezing their budget. And then there's a whole variety of government and nonprofit programs that help with down payment and closing costs. South Carolina housing programs do that. In many cases, the rate that the customer can get the loan at could be less than they might get through by shopping around for a mortgage from other lenders, and then it's combined with the down payment assistance. Mr. Dozier talked a lot about the Federal Home Loan Bank, and participating lenders do have access to some limited down payment funds, and usually those funds are used up. From what I remember, they're usually gone in about a 2 to 3 month window in the spring or early summer every year. But it's a resource, and it's available. And then there are local down payment and similar programs. And I'm familiar. I know there's some in Charleston, and Columbia, Florence, I believe in Greenville, Richland County, et cetera. They'll have programs, but again, they're often subject to financing and how their funds that they have are allocated that are coming in from either the state or the federal government. And then a lot of times there are some nonprofit programs, and under that is really Habitat, NACA, which is, they offer direct loans. It's a pass-through loan, awfully good rates, but it takes a long time in many cases for a customer to get through their process. And then a few other, just some general points. I mean, because payment is so important, if you put the numbers to the paper, if you're a little bit of a technician and an analyst like I am, you'll see that it's actually less expensive to pay a little more than to pay a higher rate on the loan. So even, so not just the buyers, but in some cases, I know we have some builders on the call, and it varies greatly among them, but sometimes being a preferred lender or dealing with the preferred lender, sometimes it often means that lender is contributing toward the closing costs, but generally that, I've seen in many cases that's offset by the preferred lender by offering a higher rate so that they can contribute toward the closing costs for the buyer for that builder. 1% toward the closing costs from a lender generally is going to mean about 0.25% higher in rate, and then that higher 0.25% higher in rate means roughly a $50 a month difference in the payment to the buyer. Well, that $50 a month generally equates to $10,000 difference in what they can finance. So they're squeezing the maximum sales price that buyer can afford or qualify for in return for a little bit of help with some down payment money. So building closing costs contribution into the purchase price can actually help because if they can borrow, if the buyer borrows at a lower cost, at a lower interest rate, $5,000 higher in price means roughly $20 higher payment versus $50 higher for 0.25% higher in rate. So there's a $30 a month difference there, but that's sort of at the small end of it. It's just a thought to put out there when you're considering how to structure affordability for potential buyers in a community. The total fees make a difference. Lender, realtor, the builder, the neighborhood fees, et cetera, they all can add up. And new construction, a lot of times, my customers, I have to caution them that their total closing cost, prepaid expenses, neighborhood fees, et cetera, is probably going to be a good amount higher than if they were buying an existing house out there. But there are trade-offs. And then finally, just the emphasize that how important educating the consumer is. The whole idea of comparison shopping, credit maintenance, in advance, not just pay things down or off just prior to when they're going to go try to buy a house, and just building the habits for life rather than just for a specific purchase. And then there's a lot of confusion out there with customers, going and getting their free credit reports, which are on an entirely different scale and entirely different algorithm than the FICO and Beacon scores that lender use. And then just finally, there were some advanced questions about student loan debts. That is a big problem often for many buyers, because we do run into a lot of people that have very high student loan debt. On conventional loans, we're required generally to use the actual ongoing payment or 1% of the balance. So a loan that's in deferment or forbearance, it can often be difficult to document firmly what that customer's payment is going to be when it comes out of deferment or forbearance. So in those cases, I've had to ask the customer, if you really want to buy this house and get qualified for the loan, you're going to have to take that. You may have to take those student loans out of deferment or forbearance, so that we can document and know exactly what your payment is going to be. And that's a trade-off for the customer. FHA, just in the last couple of months, it used to be 1% of the balance or the actual required payment if it was more than that. It's just recently we're allowed to use 0.5% of the balance on the student loans. So if they've got a $50,000 balance on their student loans, it used to be a $500 a month payment we used to have to add to their qualifications, but now we can use 0.5%, which would be $250. That's a huge difference. It's roughly $50,000 more house they can buy. USDA generally requires 1% of the outstanding balance or the fully amortized payment. So whatever their actual payment's going to be over the 15 or 20 or 25-year life of the loan, we have to document that. VA is the only loan where payment is deferred for 12 months after closing, and if it's deferred, we don't have to count a payment. House price limits. I assume the question there was referring specifically to South Carolina housing. Those limits are set by South Carolina housing. I won't pretend to know how they do that, but I assume they're backing into them based on an average income, qualifying income for the counties where they're setting it. And then USDA also has, in some cases, some maximum limits for house prices that I've seen in the past, but those are only for the direct loans, not the guaranteed loans that lenders offer straight ahead. Heirs property, obviously that's a challenge in South Carolina, because all those properties that are tied up with title issues, those properties aren't available on the market. So, the lack of availability, it's both potentially a detriment to the neighborhoods or communities where the properties are located, and it just takes them out of the market because they can't be financed. And then I know somebody earlier did touch on a higher priced home next to a lower value one. It just really depends on what else is going on. It may help the lower value one, it may not help the higher price one, or it may be fine for both. But it really just depends on the specifics. Those were the only questions I had seen. Just my final comment, a little bit of humor here. We just think that in the mortgage business, it feels like if you saw the way the sausage was made, you'd feel like there were minor miracles being done monthly in the mortgage industry. So thank you for your time and attention. I'll turn it back to you, Representative Alexander.
I was on mute. Thank you very much. Thank you very much for your comments and giving us information about from the financing side. We've had information about the programmatic side. We had information about affordable housing, the whole gamut. I'm sure there are several questions out there, many questions out there that need addressing, and we're gonna attempt to have address some of your questions in a few minutes. So make sure you have your questions, because she's looking at that information now. Assist you all in trying to address some of your questions. And Nancy, if they don't get their questions answered, who did they contact later on to try to get those questions in?
Absolutely. If you want to go ahead and type a question in the chat box, you can. You can raise your hand. We can go that route just so we don't have everybody talking at the same time. Or afterwards, you can email me directly and I'll pass your message along to the speakers. I'll type in the chat box, but my email address is nancy@southcarolinahabitat.org. So if you have additional questions that aren't answered here, or if you don't want to ask in front of the group, feel free to email those to me. I'll get them to the presenters and we'll get you those responses as best we can.
Okay, any questions? Yes, do you see any?
I don't see any, and I don't see any that came through the chat box either. So if I missed it, someone please feel free to point that out to me.
Wow. Well, I have one. I want to give other folks that. First of all, I think it's Mr. Dozier. I would like to, you can send us a number. I would like to meet with you sometime in the near future, sit down and talk about how we can address some of those needs. Or more importantly, how can we have access to those dollars that South Carolina is not applying for that are available, and what we need to do, again, particularly here in South Carolina, in Florence and in South Carolina in general. So I'll just send me your number and I'll be reaching out to you real soon in that regard.
Yeah, we'll come meet. Phil did mention about the down payment assistance running out. That is a factor of, I'm a huge fan of TD. TD is a member of the Federal Home Loan Bank of Pittsburgh, which has a different income makeup, and TD being a large world bank has access to probably $1 million like the other folks do. But basically, Federal Home Loan Bank of Atlanta members, it runs out about October because Atlanta Bank put some additional dollars in there too. So I didn't want anybody on their builders or to panic about running out of dollars. We access that, but also the point would be Federal Home Loan Bank of Atlanta works in 7 states in the District of Columbia. First come, first serve, back to kind of Phil's part about when it does run out. And we need to make sure South Carolina is prepped and ready to grab, whether it's from TD Bank or any other banks or financial institutions that are members of Atlanta, to grab that, because I sure want it to come to South Carolina and not go to the other states.
When you say run out, once that money is run out, what happens?
So when I mentioned earlier, so the formula for the Federal Home Loan Bank of Atlanta and the other 11 Federal Home Loan Banks around the country is 10% of their net earnings. So again, when I left, we made $400 million that year. There were $40 million for affordable housing grants. When that money runs out, it's out. And for Atlanta, that typically was in between the August and October timeframe.
Okay, cool.
We'll talk about that. I'll come see you.
Yeah, we'll get together real soon.
Thanks.
Let's talk about this redlining that was put into effect. This redlining law was put into effect that that somehow try to cut into discriminating of loans. I believe, particularly with the Community Reinvestment Act and my experiences in the community for these last 30 years as a public servant, when it comes to minority communities, and I think I don't know how to address this. This is probably making a statement, but when it comes to minority communities and reinvestment, it seems to me, and I've been told this several times by some bankers back in the day, none recently in recent years, but it seems to me that when community reinvestment takes place in the low income areas, it is with personnel. Maybe they'll come in and have someone, do a financial workshop, or maybe they'll come in and have somebody to go to the poor schools. But community reinvestment across town, you're talking about dollars and cents. And we see that happening quite often. You're talking about loans and various programs. We see that happening quite often. How can we address that here in this state? I know if it was happening in Florence, it's happening parts of the state as well. How can we address this whole piece of Community Reinvestment Act?
But I'll take part of it, and then I've got some good colleagues that can answer it as well. Some of it is going to happen today. As a matter of fact, there's acting director of the Federal Housing Finance Agency, Sandra Thompson. Sandra is, as everybody might know or may not know, the Federal Housing Finance Agency is the regulator for Fannie, Freddie, and the Federal Home Loan Bank. She comes from a housing goal background and announced some programs, and I got to dig into it. I was preparing for this and haven't had time, but there's going to be some housing pieces where 10% of some deliveries to Fannie and Freddie, meaning all the mortgages that Phil broke down of how to make a mortgage, and then he packages them up and sells them. There's going to be a certain percentage of that is going to be directed towards minority census tracts. So that will go a long way in fixing part of that. Again, devil's in the details. We got to figure out what the proposal was today and see how it impacts. But when you and I meet, I'll have more information on it.
Okay, good.
I'll just add one thing, Representative Alexander, back to your question. CRA requires banks to do three things: invest, make loans, and provide services. And you talked about when personnel come in and they teach financial literacy. That's one of the ways. That's providing the service side. Banks are also required to lend money. When I say lend, mortgages, small business loans, and then also community development loans, which are larger transactions. But banks are required to make loans into all of the census tracts that support where they have deposit taking offices. And specifically, I'll repeat this, but small business loans, mortgage loans are two of the major ones. And then lastly, the word investment. Investment's not a loan. Investment's when banks actually invest by buying tax credits on projects in the communities. So these low-income housing tax credits are a good example. New market tax credits are a good example. I saw historical tax credits on one of those deals. So that's how banks invest in communities, through the purchase of those tax credits. And then lastly, I will also add, in addition to the proposal that's the state housing has endorsed, that's in front of the legislature, there's another proposal that's coming in, also very similar, for money to be set aside for entrepreneurship and small business. And that's a big contributor, within the CRA world. So that plays a big role within the world of CRA. So I'll mention that also.
Okay, well, thank you very much. I'm gonna follow up on that proposal that you said is either in the Senate or the House. I'm gonna take a look at that. So let me ask you this question: If we would look at the lending tracts right now in South Carolina, if we look at the lending tracts where the money is being lended, we could probably see that it has. And I understand that banks are in the business of making money. I understand that, and I'm not opposed to that. And I understand the issue that we have, particularly here in PD, in terms of in terms of income and affordability. But if you look holistically across possibly the state of South Carolina, and let me speak more in you see there is a sense of red line taking place across our area, and somehow we're going to. And I think that our institutions have some responsibilities in making sure that everyone is given the opportunity. I'm the business of someone understand that, but where there are opportunities, I'm hoping, and more importantly, I'm praying, kind of redlining. There's some opportunities out there that I think can benefit both the landowner and the banks, and we'll talk about that a little more in general. People across the state. But if you look at that, if we're honest with ourselves, and that's what this is all about, you have not been taking place across the state. And lots of time, it is in low-income areas where they're not being taken and where it's not being had. I know specifically there's some property on one side of the street belongs to one group of people, and property on the other side of the street belongs to another group of people. And it all depends on which side you're on, determines whether or not you get money for your particular property. So that's strictly red line. It's saying that if you're a white property, your property is worth this, but across the street, if you're a black property owner with something on it, your property is less. I know that to be a fact right here and there, and we just need to take a look at those things like that. I mean, literally across the street. I'm not talking about across town, literally across the street, 100 yards from each other less, and property values are different.
I would agree.
Any questions?
We have a few more questions in the chat box, and I know that we are getting close on time, so I'm gonna ask one or two more, and then if the presenters are okay and be willing, if there are other questions you guys type in the chat box that we can't get to, if you'd be willing, we can send out a little follow-up email to everyone afterwards to make sure we get to it. But the first one before the three speakers is, do you have any added financing tips about trying to provide housing for retired veterans?
So not directly. I think there are some examples around the Southeast of veteran centers and veteran homes that have used some of the programs that we've talked today. And that's what I was talking about. Sometimes instead of creating it out of thin air, we should point to successful ways that it's been done other places and take inventory of that. And I think we could show in Virginia, and I think there's some in Florida that we could point to that are very successful. And we should ask them how they put that together and see what the use could be.
Yeah, I was going to chime in and say I assume that we were talking about rental housing there as opposed to ownership.
Yeah.
Okay. Next question is, what are some general requirements for developers to qualify for finance projects?
So, go ahead.
Well, that's a very open-ended question. I mean, generally, there needs to be, some equity in a deal. Purchase, if they're purchasing the land, I mean, every situation is different. So if they're talking about a single house, or are they talking about a group of houses, or are they talking about multifamily housing? So there's not a one size fits all answer to that question. I do want to put a plug in though. In addition to banks, there are a number of community development financial institutions that do business in South Carolina, and they're known as CDFIs, and they also lend money, especially if you're a startup and you're having trouble getting your financing from a bank. If you're trying to do, a development somewhere, I would also recommend you talk to some of the CDFIs that do business in South Carolina.
And I'd point back to Phil's good piece on some of the requirements, and he was talking about home ownership directly, but those same parameters are applicable on the commercial side. Somebody's going to come in. You did mention equity. We're going to look at credit, but every deal on the surface, somebody might say, well, how did that bank offer 100% financing to that developer? We've done that before. Representative Alexander, you'd be shocked if in Florence, South Carolina, that we did 100% finance deal. It was backed by a $40 million trust. So the guarantee on that loan made the deal more applicable. So everyone, just like was just mentioned, has its own story. But that would mean a developer needs to build a relationship with a banker and sit down and build from scratch what the deal looks like.
Wonderful, thank you. We're going to take two more questions. First one, and I think it's going to be an easy one, is what is a good resource to get more, where can someone go to get more education on tax credits?
I would start, you could start by talking to an economic development person in your city or county, because they obviously have an interest in what's going on in the community. That's one place to go. You can go to South Carolina Housing, State Housing, schousing.org. That's another place to go. You can call your local banker. Not all bankers are as well versed on tax credits, but each bank does have somebody within their organization that understands how they work. And some are competitive, some are not competitive, but they are out there for people to use.
And I'd point you to investment banks as well. Stifel is one of the largest underwriter of low-income tax credits on the affordable housing side in America, and they've got some wonderful resources on their website that helps educate on that topic.
Wonderful. For the questions we're not getting to, I do want to say that we'll send those to the presenters to make sure we circle back up and get your answers. To touch on one of them real quick, there are, and I don't want to steal Representative Alexander's thunder, there are 2 upcoming sessions on a couple of the topics that are in the chat box. So when he mentions those, do want to circle back. But the last question that I want to put before the panel before I hand it back over to Representative Alexander is, the question came in, I'm familiar with using a conservation easement to receive tax credits in return for reducing the amount of housing you put on a certain property. Is there another such vehicle to convince a landowner to sell property for a lower price so you can build affordable or workforce housing in an area where land would normally be sold at a higher price for higher priced housing?
Yeah, that's going to be a deal by deal. I mean, can you find that? Absolutely. One person's going to say yes to that, where somebody else might say no. That's just that's hard to answer directly, given the individuality of that particular landowner.
Yeah, and that's where I would go talk to somebody in the economic development role, either within your city or your county, or somebody on the planning commission or something, because more than likely there have been plots of land identified for development for special, special types of development, and maybe those deals have already been struck. And so in all of the deals that I've seen, there's always a partnership taking place between a county, a city, a nonprofit or somebody in order to make the deal work. Because again, to make affordable or workforce housing work, there has to be some kind of subsidy, whether the land's thrown into the deal or there's some equity provided by some source. There has to be some type of partnership in place to bring all that together.
All right. we could go on and on with this, but like Nancy said, if you can address we'll somehow get your questions answered in the near future. But in the meantime, we want you to mark your calendars for the 9th month. That's on a Thursday at 1 p.m. We'll be dealing with instabilities and solutions needed. That's in September. And then September the 30th will be discriminatory practices in housing, zoning, impact fees, and density issues. That's on the 30th of September at 1. And then in October, manufactured housing in rural South Carolina. All of those are at 1 o'clock. And I'm sure that if you can go to the Home Builders Association, their website, that information will be available to you. Again, we'd like to thank our speakers for this afternoon. Mr. Dozier. We'd like to thank Mr. Barat and Mr. Drumshell. And we've Senator Coleman not being able to get on. Maybe we have to put him some internet out there in the country where he is, of Lexington and Newberry. Maybe some of this movement coming down will have him access to the internet. But he was having some technical problems. And let me thank our sponsors again and again and again. Crescent Homes, Conley Builders Incorporated, Great Southern Home, Hunter Quinn Homes, Mungo Construction. And a special thank you to Ms. Nancy, our TI person for this afternoon with Habitat of South Carolina. We appreciate your technical support and your technical help in this regard. I am a former chair of the Habitat of Florence quite a few years ago. I chaired the Habitat of Florence some years ago. So for me, with the work that you're doing, and I appreciate the work that you're doing as well. And to all of you who've been a part of this afternoon, thank you all for listening. Thank you all for your participation, and spread the word that'll come again. Those dates again will be September the 8th, September the 30th, October the 20th at the same time at 1 o'clock. Again, thank you all so much. Speakers, thank you all so much. We thank you for your information. And more importantly, we thank you for your time. Nancy, thank you too for making this all available for us. You all have a good evening, a good afternoon, and a safe weekend. God bless all of you. Thank you very much.
Thank you.